everyone. I'm Martha Stokes. I'm a retired buy-side institutional trader and educator, and I have a Chartered Market Technician Association, CMT, which is a big deal because there's not many of us in the world. Worldwide, there's about 5,000 of us, and so we're a small entity, but we're dealing strictly with technical analysis, which is what I really want you to emphasize in your trading. I know everybody feels more comfortable in the crowd. The herd mentality is ingrained in our DNA from millions of years ago. The crowd is safe. The crowd is safe. But this is the modern market. And this is a structured market that's structured with so much complexity that it is no longer safe to be in the herd mentality. I want to talk about convergences and divergences of price and indicators today, because this is critically important for you to learn. Some of you have learned about what a divergence is or what a convergence is, so this may be a review, but I can assure you that what I teach today is something that you have probably not heard before unless you are a student. So, you are all students of this modern market structure. We have a lot that is going on. We have AI technology that HFTs use, and what you need to remember at all times is this. Everything you chat group in, everything you say on social media, everything you read in the retail news is all discovered and part of the professional side activity, because they are wanting to stimulate you and motivate you into buying or selling, and so that they can buy to cover or sell against you and make high profits. Your gurus are often people who make money from advising you about what stocks to trade and so on and so forth. I want you to have the confidence to trade for yourself. Each of you is an individual. Each of you is totally unique. Each of you needs to create your own platform of tools and all of this stuff that you can have and understanding, and create your own trading parameters and goals and styles. So we have a sideways action in AEP. Electric company, it's a big deal. It's regulated electricity. And of course, for all this AI technology, we are going to need a lot more electricity and water for the data storage centers. As I've mentioned before, AI is in the cloud. It rests above in a neural net, but it has to access the data and the data storage areas constantly. I can go into AI a little bit more in another week. There's a lot more to learn about that. We're talking about convergences and divergences. When we have an indicator that is a line indicator, and if we can apply a secondary, this is a accumulation distribution with an exponential moving average. If you're swing trading or position platform trading or whatever trading you're doing, I would discourage you from doing day trading. It's just too hard. It's just too complicated, and everybody can front run you all day long. And with automated systems, they don't even have to be at their desks. They just set it to strike, and they're not intentionally going after you. You're just in the way. So consider day trading as something that was great in the 1990s, but in 2026 and forward, it's so hard. Why make your life harder than it has to be? Swing trade or platform position trade or do any other of the short-term trades, but day trading, you really have to have nerves of steel and also a huge amount of capital to trade that you don't mind losing from time to time, because you will lose, because they can front run you on the millisecond scale. They're trading on the millisecond scale. You're trading on the 1 minute scale, even if it just, and your order is filled, they already know. And the automated systems are just right on it. So you really need to get away from that. I know it sounds romantic. I know it sounds like it's this great deal, but the professionals haven't been day trading since 2002. So get with the band. When we have an exponential moving average applied to the line indicators, like this is accumulation distribution, a very popular one, Good, solid. TradingView has great indicators and things. It's fun to work with. When these two are moving away from each other, it is called a divergence. When they are moving toward each other, it is called a convergence. So diverging means to be separating away. Convergence means to be coming together. In this simple, very basic indicator, there's a ton of information about what is going on. Accumulation distribution, it actually should be accumulation rotation, because distribution only happens with smaller funds managers. It doesn't happen with the dark pools anymore. They do slow rotation to lower inventory, but they would never get totally out of a big name stock like AEP. So we have a divergence here. We have a convergence here. Then we have another divergence that's short term, and then another convergence. So you can see that this is going back and forth and back and forth. And then this choppiness. So what's happening in here? And we can see that volume is constantly dropping below the center line. When it drops below its EMA, that's a divergence. And when it comes and meets up with it, it's a convergence. So we can do all kinds of things with the convergence and divergence analysis. It gives us a ton of information about what's going on. And what we can see in the most recent days is there was a divergence, and then now we have a convergence that's occurring right there. Across that, if I could. It's fighting me a little bit today. So we have these little tiny candles, and they're not in your candlestick books because they didn't exist when the candlestick books and the candlestick theories and the candlestick educators started. But right now, these are the most important candles that you have, and you want to see if your volume lines up with that. Oh, yes, it's diverged, it's connected. It's connected. Okay, so these are Pro Traders footprints. And you've got two confirming things. You've got the confirmation here, you've got the confirmation here, and you've got these candle patterns. So that when you look at this chart and you say, well, I don't see an engulfing white, or I don't see a dark cloud, or I don't see a three shoulders soldiers, or I don't see a doji, or this doji doesn't mean anything because it hasn't dropped down. It's not a morning star, an evening star. I'm sorry, but all of those candlestick patterns don't work in the modern market anymore because we have changed to a penny spread, because we have changed to automated systems. That has nothing to do with AI. An automated system is a system that's designed to trigger. When it hits this price range of penny spreads, trigger, trigger, trigger. No penny spread price range change, sits and waits. So, and these are automated and they're just going on all the time. So we have some pro traders in this mix trying to push some prices up, and periodically they do. They have these little nudges, and then all of a sudden, and you've got to stop panicking. And this is going to take practice. I want you to simulate trade this stuff when I teach you these things. I don't want you to just go out and just try it without your simulator. Get on your simulator. You're going to use your simulator for the rest of your trading lives. I use a simulator trading. I see something new. I thought, oh my gosh, the buy side institutions this past week used a new strategy. They used a whole new strategy they've never used before. It's like, oh, I have to figure this out. I have to study it. So I do it on the simulator. You'll never stop using the simulator. And if you don't have one, go get one because you need it. So this tells us a lot about this. And these little dips are nothing. They're nothing in the scheme of things because it's going to run up. And you have to get used to this because this is a totally different animal than what you were learning in the 1990s or in the 2000s, or even in more recent years after the COVID. COVID kind of did a train wreck on everything, and we're still patterning that out. That's going to take a while, but it's getting better. But if we see that these two little nudges and then volume drops really low, there's a negative divergence going on here. It's moving away from each other rather than toward each other. So that's a negative. So something has paused them, and they're no longer just before it's going to report, which is going to report on 7:30. If the data is correct, and it has 82% institutional ownership. That's huge for a big company like this. Obviously, they're very interested. Obviously, we have some things going on that are very exciting and very dynamic with this, but they have decided before the earnings season that they're not going to be sitting on that stock. Why? Because everybody's on the professional side is holding their breath. HFTs are the only ones that use AI. They use it to search social media and all these open chat rooms and everything to find out what you're talking about so they can front run them. And they can do this milliseconds ahead of the market open, or just as the market opens, they can shift and change around. They cause the huge gaps and the huge runs, and these huge, huge volume spikes are usually the HFTs gapping something down or up with a white candle. There's a white candle that gapped up, so, but not so much volume, so maybe not the HFTs. Huge spikes in volume are always HFTs. So they're looking and carrying on. So what the professional traders are going to do right now is they're going to sit back and say, okay, we have the first week of earnings and we can study to see if HFT AI moves the stock in the correct directions due to earnings season, or if it moves it in the wrong direction due to retail news. There's a lot of times when HFT AI in the past has actually gapped a stock down that should have gapped up. And so the pros are clever and they know this. So they're not going to go into this earnings season. And so they have quietly moved out of this and they're waiting to see how the HFT AI works. It's a complicated system. And I want you to study just now convergences and divergences and see if you can slowly learn to identify pro trader footprints in here based on the volume and the convergence divergence there, and price in convergence or divergence to the main primary accumulation distribution indicator. It's a lot to study, and we'll be covering more of this later on, and I am way over my time. Thank you very much for joining me. I have a lot of fun teaching you and helping to explain these things to you, and you can learn this better than an AI. An AI could never learn this stuff. They're just not smart enough. Thank you for joining me. I'm Martha Stokes, CMT.